What's up everyone, it's Karthik with MoneyVest. Welcome on board for our Market Open live stream to wrap up the entire week, which has been a very volatile week full of lots of pain and selling pressure as technology and growth stocks continue to struggle downwards, and crypto has been nosediving, so is commodities. There's been a complete flush of this system with a lot of liquidity flooding out of equities, commodities, crypto, as volatility was also higher earlier in the week, getting up to over 21. We're seeing a little bit of a pullback down about 7.5% as Bitcoin is trading back to over $67,000. There is a little bit of a relief rally coming in with a bit of a dead cat bounce happening at the moment, with the NASDAQ 100 up almost 1%. We got S&P 500 up over 60 basis points. HIMS and HERS down over 7.2%. Continuation of yesterday's after-hours sell-off from Novo Nordisk's legal action threatening to sue HIMS and HERS over the copy of their medication Wegovy pill. And we got Nvidia pushing up over 3.4%. And we got Tesla also pre-market pushing up over 1.3%. As always, we got unemployment numbers that are delayed. We're not going to get the unemployment numbers today. It's the first Friday of the month of February, but we are not getting those numbers. They're going to be pushed for next week, and we're going to find out exactly how much of this damage are we dealing with regards to the labor market, because the US did witness their biggest job cuts in the month of January, going back as far as 2009. So we are going back 17 years worth of data to go back to a year where we saw the biggest single, largest job cut in the month of January. And again, SaaS has been under tremendous pressure as well on the back of Anthropic, as well as what AI is capable of doing. And as a result, we're seeing a substantial amount of selling pressure in the software application space as well. Let's talk about iron. Pre-market, it has recovered a lot. I mean, at one point, this thing was down so much. If you come over to iron's pre-market chart, if you take a look, it was selling all the way down to $28 yesterday at around 6 p.m. Eastern. And from those levels, it's up almost 40%. Absolutely insane amounts of volatility. This is crazy stuff that we're dealing with these stocks here. This is the level of volatility that you don't see very often. But iron tanking on earnings, down over 31%, and then from its lows from after hours yesterday, up almost 40% here in just a matter of few hours. And in fact, from the pre-market trade at 4 a.m., this thing is up over 16.5, almost 17%. So again, just absolutely crazy what kind of volatility we're seeing. Why are they delayed? Too bad to show. Yeah, I mean, no idea, right? Nobody knows. But the bottom line is that we're not going to get those numbers. Did anyone lose sleep last night, or am I the only one? Really? I slept like a baby, to be honest. Like, I knock on wood. I like 8 hours straight, no F's given. I was like, okay, whatever's going on in the market, I was like totally fine. But no, I think at the end of the day, like, this kind of makes me more excited. I think if anything, market selling off gives us a lot of buying opportunities. It gives us more time to regroup and also allocate more capital into some of the highest quality names. And as a result, I'm like always excited for when the markets are selling off. Always a smile on my face, always happier, I should say, when the markets are down, because it gives us great opportunities there. Who's going to tell Karthik babies don't sleep well? Oh man, I definitely do have my work cut out for myself in the future, but oh no, I almost avoided a heart attack. I've had the pit in my stomach feeling. Same with me. Don't remember the last time I slept 8 hours. Really? You guys need to start prioritizing your sleep, man. Like, come on. 8 hours, it's at least 7 hours. Sleep is very important, for me, like it's one of the most important things over anything else is health. Health is wealth. As long as you are healthy, you can do so many things. And the markets will always be there. The money comes, money goes. But health and time Two more valuable assets for you that I think everyone needs to prioritize a lot. Okay, let's see. Best sleep ever because I knew I couldn't do anything. Me too. Watching my portfolio drop close to 100K kept me up. Yeah, I mean, it's been crazy, right? I mean, the last few weeks, we've seen some insane drops, and obviously everyone's feeling a lot less rich, a lot more poor over the last month. But that's the market, that's the nature of the market. And, it's not so much about the numbers, but even mentally and psychologically, we always have to level up. And once we start to feel a little bit uncomfortable, that's a good thing, because that, okay, you're actually, leveling up. You're almost on the verge of leveling up and getting to that next step. Because, when I first got started, even $100 intraday plus minus used to freak me out. I was like, oh my God, I'm losing $100 today. But now it could be thousands or hundreds of thousands of dollars. And it's like, yeah, I mean, you have to build up to it, right? And eventually, in the long term, let's say if it's millions of dollars, like intraday swings, that's the goal, right? The crazy thing is that, okay, one day I would want to be down $1 million, right? That would tell me that, okay, I have, or I'm dealing with such a large portfolio that a $1 million intraday swing is normal. Think about how much Berkshire Hathaway or any of these hedge funds or institutional funds, they go up and down. And that's the kind of volatility that I think everyone has to eventually get used to, over the long term. So it's all good. It's all good because this is all part of the game. We know what we signed up for is volatility. Volatility is the price you pay for long-term gains. Volatility will always be there with everything, not just the market, but with all investments, all decisions. There will always be fluctuations and volatility and ups and downs. It's all cyclical. That's all it is. Everything moves in cycles, as we already know. There's good times, there's bad times, there's great times, there's ugly times. And the most important thing is that we stick together, we commit to it, and we come out ahead. There's always light at the end of the tunnel. So that's my therapy session. Done with it. Let's come back to stocks now. Let's do some Q&A. So any questions? We are open for questions for the next 30 minutes. So let me know if there's any questions, any stocks, anything you want to go over with me, and I'm more than happy to go over it. Karthik is chilled because he made so much money on options. His Tesla stock position is probably free thanks to all the covered calls he sold. Yes, I think the 960 call or 990 call is doing very well, given that Tesla's been dropping a lot. In fact, all my options positions are up so much, like 60, 70, 80%. And that's one of the most important examples I can give you on why it's so important to hedge and learn options trading. Like I cannot, it's one thing when I say it, but it's a whole different thing when I'm actually showing you, because even when markets are down so much, options are not going to recover all the losses, but they're going to certainly make it sufferable. It's definitely going to salvage some of those losses, and it's not going to be as bad as what it could be if you don't have any options positions open. So my options portfolio, for example, has been tanking. Nvidia has been going down. SoFi has been going down. Iron, Palantir, HIMS, everything's just like nosediving over the last couple of weeks. But what's helping that portfolio at least stay afloat and do maybe even slightly better is options, because all the other ones like Iron, $60 call, up 94% or something last time I checked. HIMS, BITX, SoFi, Nvidia, Tesla, all these calls are up like 50, 60, 70, 80% as these stocks are selling off. So, why not do something about it as the markets are selling off? Why not actually make a little bit of money on the downside as well? So as I've mentioned before, my goal always is to be long stocks and short options. That is the strategy that I like to apply, which is, again, long stocks, short options. I want to be long equities, stocks that I believe in over the long term, and continue to invest dollar cost average, while also hedging if there is any kind of pullbacks and corrections like we're witnessing right now. So, okay, my portfolio is down 200K unrealized losses for the month at some point yesterday, but my sociopath tendencies are protecting my mental health. Yeah, that is crazy. I think I'm sure there's going to be a lot of people in the community and in the chat right now that are going to be down somewhat similar, more or less, but that's been, I think, most of us in the last month here, as we all are kind of dealing with the same kind of market, with technology and growth getting hurt. the most. Buying VUG, Karthik? Yes. So the plan would be to continue to dollar cost average into it. We'll pick up more Vanguard ETF every chance I get. And the fact that it is down over 6% from all-time highs, it's coming down to a potential correction. It's actually down over 9.2% from all-time highs. So, the lower it gets down to, the better. In fact, I might even pick up some VUG today, and we'll continue to dollar cost average into this moving forward, as always. Okay. HIMS cost basis is $34. I could DC it down at this point. I would just, wait for the dust to settle a little bit on HIMS, because it's just been tumbling it down. And the dark clouds over the Novo Nordisk lawsuit is definitely going to spook some investors. Not saying that this is time to bail and exit, but I think we just need more clarity on what that is going to look like. So I would wait for the dust to settle, at least get a little bit of clarity before we make any more decisions on HIMS, because Novo Nordisk is significantly bigger in terms of market cap and of course market share than HIMS. Novo Nordisk is almost a $200 billion business versus HIMS, which is a $3 to $4 billion business. So we're talking scale here. We're talking a company that's almost 10 times the size that is going after HIMS for doing something, which they also commented that in their past behavior has not been very good. They've always been copying drugs and been bringing out cheaper versions of it. So I would wait for some clarity on this before we make decisions on HIMS. DCA on Google. So Google hasn't fallen enough. I don't think it's still pretty all-time highs right now. It did drop yesterday. Buyer stepped in. And then, if you come over to Google in the shopping list, the fair value ends up at around 170, which obviously we're nowhere near close to those levels. But then we got the light buy at just under $200. Even that right now, I know feels very far off. But once again, going back to those points, that what might feel like unrealistic or very far away may not be that far away after all, given case in point Microsoft, Palantir, Amazon, Tesla, Nvidia, all the stocks that are selling off right now. Just because Google is not does not mean that Google buy levels are unrealistic. But to give you some perspective again, 182, 163 are some of those light buys, heavy buys with a fair value at 170. Which I will update after the earnings season ends. I've already got the earnings now, so I can do that for Google. But I would be watching support levels around 275 down to 250s if and when it actually gets down there. Those would be much better levels to dollar cost average into. Okay, let's see. So AI is taking jobs, yet AI companies get hammered for the very thing that they are designed to do. I can't make it up. I'm loading up. I know it is quite crazy. It is quite the irony, and the funny part is that software and SaaS companies are selling off because there's this lingering fear that AI will replace software, it will replace jobs, while they're also building AI, agentic AI, and they're making applications. And I think the whole sort of debate really boils down to productivity and efficiency. I think that's really what it is, because AI is certainly making a lot of people more efficient. To give you a very simple example, right? I was just having this conversation, not too long ago with a few people in tech. And also I keep talking about this with my developer as well. The MoneyVest platform that we've built, obviously 5 years ago would have required a team of developers, front end, back end, doing all the infrastructure, like architecture, like web services, everything that needs to be done. But now when it comes to writing code, deploying to production, everything can be done with just one person. One experienced professional can do the job of like 4 or 5 people. If they know how to work with AI, they're experienced enough to handle all of those requirements. And so I think that's really where a lot of this, problems are arising from. It's more about, coming into, the reality of it is like productivity, efficiency, one person being able to do a lot of things at once. And so, in the past, we've had this triangle org chart of management where you've got the C-suite and the upper level management, you've got the middle managers, and you got like freshers, people who are just graduating, starting jobs. But then now it's become more of a, diamond shape is what I've seen from many research and many people talking about this, where you still have the upper management, but then you've got a much bigger, fatter middle management and more expert level professionals, and then a much smaller, freshers and people who are just getting started. So that also is one of the reasons why I do think, and I mentioned this in my yesterday's video, that we might be heading into a very temporary environment of higher productivity and also higher levels of unemployment. And then that could lead into one of those two options, which I mentioned in my yesterday's video. One of them is having a full upgrade cycle where everybody starts to embrace AI, use it, and put it into their own workflows to become more skilled and more experienced and more efficient. Or the other one is that we obviously see demand kind of taper off, because as people get laid off, we don't have as much demand anymore, and companies will have to eventually cut down prices, and that leads us into a bit of a deflation and worst case scenario into a recession as well. So yeah, those are a couple different scenarios that we talked about in our yesterday's market update. But let's come back here. Maybe a dead cat bounce today, green or red today. So again, it's anybody's guess. DC and Google, we covered that. So what do you think about Team? Sorry if you've covered that already. So let's take a look at Atlassian. And Team here also we covered in our yesterday's market live stream, as it continues to break down further. And support level is right about there, which is also, it's breaking down now pre-market, trading under $97. And the next support is going to be down at 66. So if this continues to break down further, the $66 is going to be that next support level to watch. But looking at the fundamentals, it's actually looking to be very cheap now. Earnings expected at 477 on a non-GAAP basis, and the stock's trading at 97. So you're looking at a stock that is trading at under 20 times earnings now. So 20 times earnings and a little bit under 5 times sales. And that's where the overreaction comes in. There's a lot of companies right now that are getting sold off left and right, and there's a lot of overreaction in the market at the moment. Can we look at Bitcoin's chart? Please be gentle to it. It's been through a lot. Yes, it's been through a ringer for sure. And it looks brutal, to be honest. Like, it just doesn't seem to... Let's do another poll, all right? We did a poll yesterday, like last time. Let's do it again. Has crypto bottomed? Okay. Goes for both Bitcoin and Ethereum. So let's see what people say. Because last time we did this poll, 70%, over 70% said that it's not bottomed, and it did indeed drop further. So we did that poll when it was around the mid 70s. And then of course it dropped further now to low 60s. And then we're doing this poll again. Has crypto bottomed? I'm curious to see where everyone's going to be with this poll. Okay, let's take a look at SoFi. I see a couple questions about SoFi. Still feel good about silver at 70. Yes, so 70 for me is a good DCA level. Can it drop further? Absolutely, of course. Anything can drop more down. But $70 I think is a very strong support that it's holding up. But again, only if your time horizon is long term. For me, commodities, silver and gold is not for speculation. It's not, okay, buy 70, sell at 80. I'm not trading this. I'm not speculating over this. It's essentially a long-term hold for me. So I'm happy to pick up more at around $70 for silver, and for gold under 4,500 is what I mentioned before in the previous updates. Okay, confident the market will continue to correct and better deals will be available. 100%. I agree with that. Wait until AI starts making happy meals. There are traders who ignore the news and trade solely on technicals. I found that interesting. Lots of explanation for downside sound like fortune teller attaching any reason they can find. 100%. I think a lot of what media does is try to attach a reason to a sell-off. It doesn't always have to be a reason attached to a sell-off. Sometimes markets sell off just because they want to sell off. And for us, it really is an important game to understand when there is an overreaction, either on the upside or on the downside. We're not so much as to, worried about the reaction itself, but whether there is an overreaction of something is where the opportunity lives. So that is what we are here to discuss and analyze. And then for every company also, we have to look at, whether there's an intrinsic value and what that is, and whether that stock is trading above or below its intrinsic value to better understand whether it's undervalued or overvalued. How often does he go live? Who? how often goes live? Are you talking about me? I go live Monday through Friday from 8:45 a.m. until 9:30 a.m. Eastern. 45 minutes of Q&A, talking about stocks, different companies, different questions from everyone, and then we wrap it up. Everyone vote yes on the poll. I need to sleep tonight. Oh man, but this is still better than the last time we did this, because last time it was at 70%, right? 70% that crypto has not yet bottomed. And right now we're at 64%. So at least it's a little bit better, slightly better. 6% of the people have kind of leaned back to yes. So that's good. So coming over to SoFi, SoFi also breaking down below this huge area of support at 24, right? So this was the green rectangle. It was validating that support multiple times. It was range bound for a long time since August of last year. So you can see that it was bouncing back and forth here. And then it finally broke down. This was the key turning point for SoFi. And since then, it has just been sliding down. Next support is going to be 1835. You guys know where my fair value is. It's exactly at 1950. So we are trading very close to the fair value now. And resistance is going to stay put back at over $20 per share. So SoFi oversold, close to the fair value, reported very good numbers, record product growth, record members growth, record originations, record revenue. Everything was solid. And the stock absolutely tanked. So that's what my latest thoughts are for SoFi. Okay. What is my view on Broadcom? I've been picking up Broadcom. So I picked up another 10 shares. Again, slowly and steadily building a position in this. I do think Broadcom is trading at quite attractive levels. So one of the things that is now available on our platform, as I mentioned, is the analyst estimates. It's very, very important because this is literally coming from Wall Street, right? So if you come over to analyst estimates on Broadcom, it's showing you, okay, what is the current rating based on 50 analysts on Wall Street? What are the price targets? But for me, the most important thing is not the price target, not the rating, but it's really what are they projecting for EPS and revenue? And what is the forward price to earnings multiple? So for example, for fiscal year 2026, right now, we've got average at $10.25 for Broadcom, which is about 115% growth, putting a forward P multiple for Broadcom at 30. So 30 is the forward P multiple for Broadcom at current prices. If obviously it drops further, it's going to be trading at a much lower price to earnings multiple, which is even better. And so for me, Broadcom, strong company, very, very important in the semiconductor ecosystem, trading at 30 times earnings, happy to take it. But again, the lower the better. So anything under 300, I would be even more interested in Broadcom. Okay, so that is covered. I think people have forgotten about how much the Max 7 rose during the past 2 years. There's plenty of room to drop. 100%, I think recency bias, that people have short memories. And I was looking into one of the cycles. So there's a lot of cycles that happen, with the market. There's a lot of different kinds of cycles. There's a 7-year cycle. There's a 10-year cycle, 20-year cycle relating to different commodities. But one cycle that was very interesting, it's a psychological cycle. And that's a 100-year long cycle, because in that research report, the author mentioned that every 100 years, the human cycle resets. Because if you look at the people from 100 years ago, they made the same exact mistakes psychologically, because fear, greed, panic, all of our emotions, they stay the same. And they made those mistakes, and that's why we never learn from our mistakes. Because every 100 years, there's a whole new people that are ready to make the same mistakes as humans. And so that cycle will always, always be there. And that's what makes the market so interesting and so fascinating, is that no AI algorithm, no technology, nothing can really beat the game, because at the end of the day, it's really humans that dictate those decisions. And we are in most cases, at the mercy of our own emotions. And so once you take those things out, that's where success lives, right? That's where you become a lot more disciplined investor and trader. But that was a very interesting take, that every 100 years, the emotional cycle, the psychological cycle resets for humans. And we end up making the same mistakes all over again that we did. So, but the most important thing is, of course, as investors, we have to learn from it and make sure that we don't make those same mistakes again. But to your point, I agree. Max 7s have gone up a lot. A lot of stocks have, right, over the last 3 years as the markets were on this 3-year bull market. We saw double-digit returns from the S&P 500. So, so far this year, if you come over to the SPY seasonality chart, we are down for the month of February, obviously down 2%. And even for the year, I think we might have just turned red for the year, given the amount of sell-off that we're seeing. Year to date, the S&P 500 officially is down over 1%, and the NASDAQ is probably going to be down a lot more than that. It is down for the year a little bit over 4%. So definitely a lot more concentrated tech sell-off is what we're seeing. Yeah, what's the name of that bias called where people think stocks are going down forever when they are dumping or going up? So yeah, that's the recency bias I just went over, where whatever the more recent trend is, we extrapolate it into the future and we think that that's going to go on forever. And that is so prevalent in our comment section as well. It's so funny because once the markets are going up, and if I come out there and start saying, hey guys, like we need to ease up a little bit, market's scaring me a bit, people are going to be like, no, markets are going to be hitting new all-time highs. We're going to go higher even more. And the same thing is on the way down. When the markets are down 20% and I found like, okay, let's just start buying risk reward is really good. And then people are like, no, you're too early. Like markets are going to drop further. It's going to keep falling. And that's the recency bias. It just keeps happening over and over again. Cycles. The best book for cycles is The Most Important Thing by Howard Marks. I definitely encourage every investor should read that book. It'll teach you so many things about market cycles that it is just a really fascinating. Changed the way how I think about investing forever. 100%. I recommend that book to every person who wants to invest. It doesn't matter if it's like stocks or real estate or anything. If your goal is to invest your money, highly recommend that book. Okay, so SoFi we covered. Nebius, let's take a look. Is it good at these levels? Let's take a look here. Also been dropping. I would wait for like 62, 63. That is the next support in case it breaks down, and looks like we have a little bit of a gap to still fill in. So this was the gap that was left back in September, and it hasn't filled entirely down. So if it drops further, that would be the level $62, $63 for Nebius. Broadcom still on a downtrend support. So not necessarily on a downtrend. It's been consolidating sideways. But if it does break down, which it is right now, it's struggling at that resistance. And yes, you could make a case that it's actually making a lower high and lower low. So this is, the downtrend for Broadcom. Then the next support is going to be down at 284, 285 for that stock. Can you look at Fortinet? Yes, we'll take a look at Robinhood, Fortinet, and how about Amazon? We'll cover all those. What crazy is that we are barely down from all-time highs, and it's causing a frenzy. Imagine 20% drop for NASDAQ or SPY. 100%. Because of the, their aggregates, law of averages, indices don't go down as much as individual stocks on the way up or on the way down, both cases. But you're 100% right. Like if the markets were to tank 20%, a lot of individual stocks would just get blown out. 30, 40, 50, 60, 70% would be easy. Markets won't even blink before we get down there. That's how crazy and violent the selling pressure can be sometimes. That's why the saying goes, staircases up and elevators down, because the markets do indeed take elevators down. And those elevators are fast when they're going down. But let's take a look at Fortinet, Amazon, and a few other names. So Fortinet consolidating sideways. We have a gap to fill in all the way in the 90s. So a lot of consolidation in this range with a resistance up to $87, $88, support level that's going to stay put at 72. Let's come back to the platform and look at Fortinet here. Plug that in, come over to the analysis on this side, analyst estimates. We've got a hold rating with a average target of 84, median 87, a high target of 90, and a low target of $70. With a forward PE now sitting at under 30, revenue or EPS expected at 269, 19% growth, then 9% growth, then 10% growth. So 3-year CAGR is about 13%, but look how the forward P multiple comes down, right? So it comes down from 30 down to 24, but then it goes back up because of that expected decline in EPS in 2028. So That's the EPS forecast. Revenue is also expected to increase 13 to 11%. So double digits, trading at just under 9 to as much as 7 times sales for the business. So Fortinet still is a pretty strong stock in my view. If you do some very simple analysis for 5 years and we grow them by, let's say 15%, let's see, just do this right here. And we grow them by 20% and put them at 25 times P multiple, hit calculate, arrive at a fair value of $82. So I think Fortinet 20% is, I think, might be a little bit high. Let's do 15%, and we're looking at around $66, which is 16% lower than where it's trading right now. And where is my shopping list fair value? 67, yeah. So almost perfect, right? 67 was the fair value that was already there in the shopping list from back in October. I just calculated it with a 15% growth rate, and that comes out to around $66, $67 for Fortinet. So yeah, that would be the level, but the support level at 72 for Fortinet. Okay, how do you determine your buy price? Well, it's a combination of fundamentals and technicals, right? So we have to apply both disciplines. Fundamental analysis using simple quantitative and qualitative analysis, looking at, future cash flows, future earnings, discounting them back to present value. And you can use whatever discount rate you want, right? That's the beauty of running these models, is that you can actually use whatever discount rate. So this is the discount rate. And the discount rate is essentially what is the rate of return that you actually want. Since I want 12% rate of return, I'm using 12%. But look what happens if I bring this number down to 6%, right? If I cut this number in half and go with the same exact analysis that I just did, which is 15% growth rate, 25 times P multiple, and hit calculate, now we're looking at $87 as your intrinsic value. But the moment I increase my discount rate to 12%, then the fair value comes down to 66. So that's 87 to 66. It's a $21 difference between the discount rate. Now look what happens if I go with a 0%. I don't know if this calculator is going to allow me to do that, but let's see. There we go. So if you do 0% discount rate, then the fair value is $116, right? That means if you buy it at 116, you're most likely not going to make any money from Fortinet based on discounting the future cash flows and earnings. So this is really just an underwriting tool, right? Just a calculator to better understand, based on the growth expectations for revenue and EPS, based on a potential multiple that we think is appropriate for that company, based on the share dilution, how much are they going to be buying back shares, and applying a margin of safety, what is the true intrinsic value of a stock, and then combining it with the technical analysis to better understand, that price is the anchor for that stock. So the market is the fastest draw in the wild, wild west. Mag 7 needs to continue hitting their earnings estimates every quarter. If they miss just a bit, they will get punished due to all the money they are spending on CapEx. I agree with that. I think the expectations are set quite high. And that's one of the reasons why Amazon dropped so much, is because they raised their CapEx guidance even further. And look at that drop here, down over 8.8%, back in the low 200s, and blowing through not one, but two support levels off of just one earnings. The margin for error is very, very slim in this market right now. We're kind of like trading, or we were trading at a point where it was all priced for perfection, and the slightest of errors or missteps can put us down, 10, 20, 30%. I mean, Palantir, price for perfection, over $200. For what? For what? I own Palantir. I love Palantir. I've been talking about Palantir for such a long time, but it does not deserve $200. Like, that's an insane value. I would even argue that even at 140, 150, before I get canceled, I know even at 140, 150, it's an expensive stock. Not saying that it's overvalued, it's like a bubble, but it is an expensive stock to own. And so my fair value came in at $87, $86 last time I calculated it. And that's what we have to be like objective about, regardless of our personal biases, regardless of, whether we're in the stock or not, what do we feel about it. Numbers don't lie, and numbers is what makes most sense for us. So I think a lot of these stocks were priced for perfection, and they're just like getting a bit of a reality check, slight reset. And that's always a good thing. That's always a good thing. It needs to happen periodically. Otherwise, the higher they go, the harder they fall eventually anyway. So Okay, please take a look at my comment. What is your comment? I don't get it. It doesn't matter that for the past 3 years, Max 7s went up. What matters is if this was justified, meaning what were their earnings growth, PEG, and multiple is also important. But if it's not high today for any company, then except Tesla. Yes, correct. But I do think the prices went up faster than earnings did or revenue did. So that's where the multiple expansion comes in, right? Multiples expand when the numerator is growing faster than the denominator. And the numerator in this case, in any multiple, is price. If price is growing faster than the denominator, which is earnings or revenue or cash flow, then multiples expand. And then for those reasons, I think the market starts to, like I said, price them for perfection and for continued growth or continued. That's one of the biggest risks for any growth stock. I think I mentioned this before with Upstart as being a case in point, is once market stabilizes and the growth rates are no longer growing at what we've seen before, that's where the biggest risk for that company ends up being, is expectations versus reality. So I think if investors can manage those expectations well, we are in for less disappointment. And that's why with the analysis that I do, as I mentioned before, I want to keep my expectations as low as possible, very realistic, so that I always want to get pleasantly surprised. I always want to have a good surprise, not a bad surprise. So multiple is not high for all Max 7s. That's the thing. So if you look at PEG ratios per se, like for example, Apple, Apple's PEG ratio is quite high, I would argue. I mean, it's trading at a 35 times earnings, 35, right? And the earnings growth is nowhere near close to 30% per year. 2026 will be 845. So 845, and then last year was around 746. So that is a growth rate of 13%. 13%. Is 13% a high growth stock or is it a regular growth stock? If it's a regular growth stock, I mean, it doesn't deserve 30 plus earnings multiple. Microsoft has now come down to 26, right? This is after a 30% drop. After a 30% drop. So it was probably more like 35 when it was trading at an all-time high. And if you look at earnings, we're looking at 1640. So 1640 divided by 1365, 20%. So again, 20% growth for a company that's trading at 35 times earnings. So the PEG ratio is certainly well above 1 for these companies. So they've always really demanded higher multiples, right? So they've always demanded higher multiples because of multiple different reasons, but that is, again, pricing for perfection. If any misstep or anything goes wrong, then that's where the risk comes in. And then Tesla, of course, you mentioned earlier, very high multiple. NVIDIA, I would argue, has been a bit more. Honestly, NVIDIA, based on its growth expectations, have been a much better growth adjusted value than compared to Apple or even Microsoft. Because earnings growth are just insane. 774 for 2026 versus last year's 468. And that's a growth rate of 65%. So 65% for a company that's actually trading at around 40 times earnings. And that's also on a trailing basis, forwards even lower. I think NVIDIA is still very good, very well priced. Okay, so make as much sense as AI putting software out of business, even though these are the companies buying AI solutions to improve their software performance. Absolutely crazy. Just very, very funny what's going on in the software space. Even if they exceed earnings, the street doesn't appreciate reinvesting into the company for future growth. Your take on Enphase. So Enphase did, I think, have a few good days, but I think we're back to where Enphase is really it's good at is going down 8.5% yesterday. Of course, it rallied over 38% on earnings. Support level now is going to be at $47-48 for Enphase. Okay, let's see. Love you speaking about the truth on Palantir. Great long-term potential, but like you said, currently overvalued. expensive, right? Stock's expensive. I think that's how honest as I can be. Axon, let's take a look. Axon's been getting some orders from Minnesota. And of course, last couple weeks down over a little bit over 38%. If you come take a look at the value here, let's see, earnings have 2026 $759, and it's right now just over $400. So we're looking at around 52.5 times earnings multiple for a company that's got a good balance sheet and 13 times sales and a little bit over, I think 60 times cash flow for the business as well. So head and shoulders, a little bit of a breakdown now, and support level for Axon next is going to be staying put roughly at 346, 347 for this company. So this will turn into a resistance. And the next support, like I said, is going to be 346, 347 for this stock. All right, everyone. So market's about to open. Let's do this. Let's see what are we going to experience today. But 64% of people are still expecting crypto to go down further. In fact, we have not bottomed for crypto, for Bitcoin or for Ethereum. That's quite interesting. People are expecting more pain in the world of crypto, Dave. So you're probably not going to be able to sleep or have a good weekend, given that the people have spoken. So, all right, everyone. So markets are open. We got QQQs selling off a little bit here on the open. We got the SPY up over 60 basis points. NVIDIA also giving back on some of the gains. Focus for today is going to be on Amazon, of course. Amazon, Iron, HIMS. Those are the three that are moving the most. We got Amazon down over 8.4, now over 9% down, with HIMS also selling off a little bit further, getting bought up on the day so far, but down over 4%. And silver and gold also trying to recover a little bit here on the day. And so is Ethereum and Bitcoin, both up over 7% right now as volatility comes down. So thank you so much for joining, everyone. I really appreciate it. Again, if you want to get access to the entire MoneyVest platform, we're building something special with the new features getting launched every month in 2026. We're going to be building a lot more on this website to give you full access, full everything to conduct fundamental analysis on every stock in the US. So link's going to be down below if you're interested in joining, and of course getting access to all the trade alerts, members only videos, portfolio updates. All of that is going to be available with the link down below. As always, have a great weekend, happy investing, and I'll see you all in the next video. Take care.